Okay, let's try to unpack this really fascinating and almost impossible contradiction that is NXXT, NextNRG. When you look at all the research, you see a company that's just swinging wildly between, being this high-growth, cutting-edge leader and, well, at the same time, a startup that's just struggling to keep its balance sheet stable.
That paradox is exactly why we're digging in here. For you listening, NXXT is kind of the ultimate high-risk, high-reward profile in the whole energy transition space. We have to unify those competing stories. Is this a hydrogen powerhouse built on, amazing IP?
Or is it fundamentally just a cash-burning energy company fighting for its life?
Yeah.
Our mission today is to connect those dots.
Right. And you see that ambition and that risk reflected in your business structure.
Yeah, we're mainly looking at their core hydrogen infrastructure solutions,
Yeah.
the HES unit, and their modular electrolyzer units, the MEUs. But you can't ignore the newer stuff, the smart microgrids and battery storage. I mean, they're casting a really wide net.
It's a massive undertaking, and that scale is what's causing all this financial tension. But to really get that, you have to start with the bull case, because the foundation they built early this year, specifically in Q1 2025, was genuinely impressive. It looks structurally sound.
And that's where the numbers really jump out at you. Looking at that Q1 report, revenue hit $48.2 million. That's a 37% jump year over year. But the core parts of the business, they were accelerating even faster. The HIS revenue, that's the refueling stations and maintenance, that was up 62% year over year.
And that 62% wasn't just, a fluke. It was strategic. It's backed by these sticky long-term relationships. They rolled out 18 new stations. And the crucial part is that all under multi-year O&M contracts with big names. We're talking XPO Logistics, the Bay Area Air Quality Management District. That locks in revenue. It's stability.
Exactly. And the MEU side, those are the actual electrolyzers making the hydrogen, they were up 49%. But the most exciting metric for me, the one that really hints at future profit, was the margin expansion.
This is where their competitive advantage really shines.
Yeah.
We should probably pause on this. Their gross margin expanded to 38.4% in Q1. That is a massive 730 basis point jump from the year before.
730 basis points. Can you just quickly put that into context for us? What does that kind of improvement signal for a company like NXXT?
It signals they're fundamentally changing the economics of their business. They're turning what could be a commodity into a high-margin product. You only really see a jump like that when you have a cost breakthrough that your competitors simply can't copy. And for NXXT, that breakthrough is vertical integration.
That's the aha moment. They brought production of those really critical, expensive internal parts in-house. The bipolar plates and those sophisticated membrane electrode assemblies, the MEAs.
Right. And that move alone cut their outsourced component costs by 22%, a huge number.
And it wasn't just that, was it? They also went after their supply chain costs.
Oh, yeah. They locked in these long-term fixed-price deals for their PGM recycling feedstock. That's platinum group metals, which are essential for the whole process. They got it at $120 per kilogram.
Compared to the spot price, which was around, what, $180?
Exactly, $180. So it's not just a one-time discount. They've effectively hedged themselves against massive inflation risk. They've cost certainty for years. Their competitors, who are still buying on the spot market, just don't have that.
It creates a real competitive moat. I think the research said NXXT is one of only 2 U.S. companies with that full end-to-end control, from the electrolyzers and stations all the way to the software and recycling.
And that control is protected. They've got 14 issued U.S. patents on things like MEA durability and their thermal management systems.
So for a fleet operator, why does a patent on MEA durability matter? How does that actually translate into value for them?
It's all about uptime and lower maintenance costs. It's that simple. Competitors have to buy these high-performance parts from third parties, so NXXT avoids a, 15 to 20% higher cost right off the bat. Plus, their software platform, NextXT, creates incredibly high switching costs. Once your fleet is on that system, moving is a nightmare.
And you see that in the contract lengths. Something like 92% of their station clients are on contracts for 3 years and longer. That sounds like reliable high-margin revenue, the kind of thing that should make an investor feel pretty secure.
It does. It sounds like a super healthy, high-growth company, but this is where the financial whiplash hits you. We've just outlined these bulletproof fundamentals, this incredible moat they're building, but the cost of building that future is showing up in a really painful way on the balance sheet.
The contrast is just jarring. Trailing 12-month revenue is near $73.5 million, which is good, but their profit margins are deeply, deeply negative. We're talking negative 95%.
And their EBIT margin is also in the red at negative 81%. It means for every dollar they bring in, they're spending almost $2 to get that growth. And the immediate price for that is a severe liquidity strain. The current ratio is 0.1.
The current ratio of 0.1 is, I mean, that's a bright red flag.
Right.
In real terms, what does that mean for them day to day?
It means for every dollar of short-term debt they have coming due in the next year, they only have 10 cents in liquid assets right now to cover it. This isn't just a bad ratio. It's a screaming signal that they are relying entirely on getting external cash and getting it now.
Right, and free cash flow is still negative, about negative $7.77 million. They put 100% of their capital into expansion, specifically for that new 200-megawatt MEU line in Phoenix. It's a massive gamble.
And this relentless spending, this CapEx, it leads to a really mixed signal when you look at who's trading the stock. You've got clear bearish signals from insiders. A director sold over 31,000 shares. The CTO sold 15,000. That suggests, they're taking profits, or maybe they're worried about the cash crunch.
But on the other hand, you have this massive institutional accumulation. I mean, Sumitomo Corporation added 1.2 million shares. Caxton Associates 0.72. They also added huge new positions. Institutional ownership jumped from 14% to 29% in just a few months.
That's the fork in the road right there. The insider selling versus the big institutions buying. It tells you management might be worried about the next 6 months, the cash, while the institutions are valuing the IP and the long-term catalysts. They're betting the foundation outweighs the short-term risk.
Okay, so we've set up the structural advantage and the immediate financial threat. Let's pivot to those catalysts the institutions are watching. There are some concrete wins, right? Like that big deal with Southern California Gas.
Absolutely. A $17 million deal for 30 refueling stations through 2030. That's a real confirmed backlog. It helps de-risk things.
And there's another move, the MOU they signed with A123.
Right, and that shows they're focused on the supply chain and on, federal policy. It's about bolstering domestic battery growth, aligning with the Inflation Reduction Act incentives. It's a very smart play.
And what about Q2 earnings? The market is expecting continued growth.
Yeah, consensus is looking for revenue between $55 and $58 million, but the real show is going to be the demo of their new 1MW MEU prototype. That's happening at the Hydrogen Industry Summit in June.
And that efficiency number they're targeting is really worth remembering. 9.8 kilowatt hours per kilogram of hydrogen. That is measurably better than what leaders like LG Chem are doing, which is closer to 10.5. So they are really pushing the tech forward.
Okay, now we have to talk about the speculative catalysts, the big ones that could solve that liquidity problem overnight. The biggest unknown, the one that's probably powering all that institutional buying, is a potential Department of Energy grant.
The $120 million Hydrogen Hub Expansion Program.
Exactly. NXXT is reportedly shortlisted for hubs in Nevada and Arizona.
That's the ultimate binary event. If they get that money, it's non-dilutive federal funding, free cash. The shares could pop 40% or more. Based on what we've seen with competitors, it just erases the liquidity risk.
And we can't forget the microgrid angle. This is probably why some of those analyst targets are so high. Their proprietary AI-driven software, the Next Utility Operating System, or UOS, is a piece of IP that's totally separate from their hydrogen hardware.
So this software isn't just for the hydrogen stations. Can you elaborate on why this is so valuable? Who's buying this?
That's the key. The UOS is an AI optimization layer. It reportedly cuts power downtime by 10% and interruptions by 17%. The customers here aren't just trucking fleets, it's utilities, hospitals, and most importantly, data centers, places that need guaranteed, hyper-efficient power. It opens up a high-margin, recurring software revenue stream, and it's much less capital-intensive than building factories.
It makes sense why they attract so many rumors then. You hear whispers about a partnership with Tesla, or maybe an acquisition by a big utility player. And even if they're just rumors, it shows the market sees the strategic value beyond just hydrogen.
Which brings us to the charts. The technical setup right now is signaling a potential major move up, which is very unusual for a company under this much financial stress.
Visually, if you look at the price action, you see this multi-month basing pattern. Consistent higher lows, moving from around $0.95 up to $1.42. The chart's showing a classic cup-and-handle pattern forming since January. If that breaks out, the target is around $2.05 to $2.20.
And you also had the Golden Cross confirmed back in March. The 50-day moving average crossing above the 200-day, that's a classic long-term bullish signal. It suggests the underlying trend has fundamentally shifted no matter what the quarterly cash flow looks like right now.
But the analyst ratings really reflect that extreme risk and reward we've been talking about. Raymond James has a pretty conservative target of $2.50. They're pricing in the risk, but still see that path to positive free cash flow.
But the average target is much higher, around $5.50. That implies a, well, staggering 429% upside from recent levels. Those analysts are clearly focused on the microgrid software and that potential DOE grant. They're just looking right past the short-term pain.
What about the practical risks for an individual investor, beyond the cash burn?
Well, the biggest one is probably the low trading liquidity. The average daily volume is only about 1.2 million shares. So any big news or a big fund selling off could cause massive volatility. That's tough to navigate.
And what about regulatory risks, like from CARB in California?
That's actually less of a concern because they control their MEA production in-house. They can adapt their tech quickly. The key risk is still timing. Can they get the cash they need either from the DOE or from profits before the current pool runs dry?
So to synthesize this whole thing, NXXT is this textbook case of divergence. You have a fundamentally innovative company with superior, vertically integrated IP and major confirmed contracts. So Calgase, A123, it's positioned for leadership.
They are financing that massive growth with very limited short-term capital. It creates a classic high-risk, high-reward profile. The price movement over the next 6 months really hinges entirely on them hitting their roadmap, getting to free cash flow positive, and, of course, securing that game-changing DOE grant.
And that leaves you, the listener, with a final thought to mull over. If NXXT is successfully managing its long-term risk by integrating its supply chain and securing these domestic partnerships, where is the true long-term value? Is it in the efficiency of the patented hydrogen tech, or is the deeper, more resilient value actually coming from that high-margin, AI-driven microgrid software?